Let's take a look at some recovery times for the stock market throughout history versus CDs. Now, sometimes people get really nervous during a downturn. They say, I can't stand the heat. I want to put my money in CDs. Well, let's take a look at what would have happened. How long would it take to recover if I did that versus sticking with stocks? And I'm just going to use a portfolio of large, small, large value, and small value stocks to do that with. In November of 2007, we had a downturn, and it hit bottom in February of 2009, recovered by September of 2012. It took 26 weeks for our stock portfolio to recover fully from the downturn from the bottom. How about CDs? 502 months, or about 41 years. How about in October of 1987? How about that one? Well, 16 months for stocks to recover versus 199 months for CDs to recover from the bottom. That would have been 16 years. 1972, we had a downturn that lasted until 1976. Took about 13 months for stocks to recover versus 324, or 27 years. How about this one? 1968, 1970 hit its bottom. In 1972, it was recovered. 20 months for stocks, 306 months, or 25 years. So if you were 70 when it started, you're 95 by the time it's back. Then we have the granddaddy of them all, 1929. Market went down. It took a long time for it to recover, 127 months for stocks. That's a long time, about 10 years. Versus CDs, though, 1,200 months, or about 100 years. If we look at a University of Michigan study, let's say we bail out. We've got to know when things are going to get better. But unfortunately, markets move very quickly. 96% of market gains they found in the study from 63 to 2004 occurred in 0.9% of trading days. So the points to remember is time in the market is way more important than timing the market. And market downturns are periods in time when money is transferred from the fearful to the educated. Become an educated investor.